So we might have these, I think inflation falls, and I think the Fed pivot soon. It's like 2018. But 2018, the S&P was down 22%. It's only down about 15, 16 now. So I think there's more pain to come before the Fed suddenly realize that growth's gone. And the bond market will tell us that first. It always does. Yields will start falling, and that will be probably the signal, as we had in 2018, crypto stabilizes, the growth end of equity starts stabilizing because they realize that some stimulus is coming. And so there's a lot. It's a bit of a monologue, but there's a lot to get through. Now, if inflation is still high-ish, because it's going to take a while to come down, but I think it comes down pretty fast. But let's say it's still at 5%, and the economy is now headed directly into recession. What do the Fed do? Well, they're unlikely to purely stimulate it because optically that doesn't look right. So my guess is they'll do what Europe's starting to do and Japan's starting to do, which is direct transfer payments that I've been talking about for a while, which is basically MMT. So i.e., you give money to the people who need it to cover the costs of their bills going up, because that's the end of the entire system. So it's a really complicated picture. But I think we end up with negative real interest rates ongoing, onward use of stimulus, maybe in a more targeted approach, because we can't allow the debt bust, which is why the Fed will pivot soon. They'll have to.
What do you mean by the debt bust, Raoul?
Well, so the world is the most indebted it's ever been as a percentage of world GDP. The US is the most indebted country as a percentage of world GDP of any country in all economic history. All of that is against the collateral. So you borrow money against something. So you borrow money against your shareholdings, you borrow money against bonds, you borrow money against your house. So if you allow the price of those assets to fall too far, your debt gets liquidated. And we can't allow that because it's too big. I mean, these are hundreds of percent of GDP. So you basically could destroy everything. So that's why we need to be super careful. That's why the central banks panic and buy things like, if you look at in the pandemic, they started buying mortgage bonds and they bought corporate debt. It's because if you allow that stuff to go bust, the whole system's blown up. That's exactly it. And I think the phasing of this is, I think the oil market needs to break, because that's the headline inflation thing that real rates have been following. And it feels like it's starting to happen now, but it needs to break a bit lower. And then, if the oil market comes down to $70 or so, that's going to ease a lot of people's fears, because this Russian fear is in everybody's minds, the oil market. So if that happens, I think that happens first. The dollar is helping bring down inflation. The next part is the bond market will tell us. It always does. The bond market, much like 2018, there was that final panic in 2018, in December 2018, where the equity market puked. We had higher inflation, the dollar was going up, then the oil market broke, and then finally yields started rallying. And that was the signal that the Fed were going to pivot, because the bond market does the job for them. So if the bond market raised the rates, the bond market's going to ease them too. But it's just not got there yet. So it's very close. And I think we'll see, so far we've been seeing yields going up and equities going down. And soon we'll see equities going down and yields going down. Then we've got to the signal that that the market's going to start pricing in the other side of the cycle, which is the stimulus side. So we've got to get through these phases. But usually what happens for risk assets, particularly things that are influenced by inflation and interest rates, which would be crypto and growth tech, they tend to start to stabilize and outperform at this point once the bond market turns. Because that's why they've been hit, because of the future inflation expectations, because they're long duration assets.
I think we want to talk about like tech stocks in just a minute, but I feel like I have there's still a few like fundamental kind of questions about the current state of macro in the market right now. Just one question that's just been lingering in my mind for quite some time. We had Dan Moorhead from Pantera Capital on the podcast, and he talks a lot about the bond market bubble. From your perspective, Raul, why is anyone buying bonds these days? That's something I haven't been able to wrap my head around. Like, who is buying bonds, and why are people or institutions, maybe let's say, buying bonds?
So I think people get really confused around all of these topics. People confuse inflation and debasement for starters. So inflation is the rate of increase in prices, and debasement is the devaluation of the purchasing power of a currency. In fact, most of the world's lending is done by the Eurodollar market, which is the offshore dollar lending markets, generally driven by the European banks, the Japanese banks, and some of the Asian banks. It's a game of musical chairs because the moment that growth slows down or growth is too fast, generally it's when growth slows down. When growth slows down, people need dollar financing and there's less dollars in the system. If the Fed are withdrawing liquidity right now, there's less dollars. So you're taking a few chairs away. First one was Sri Lanka. They're like, where's my chair? Gone. Right. And you'll see one country after another. We're now seeing China starting to devalue its currency. It's because part of their chair has been taken away. One of the chairs has been taken out of the room. So that's what happens is there's too much dollar borrowings. And in a slowdown, people need more debt. And there's not enough debt being given out because the Fed are taking. So if the denominator's going up, then the price of the commodity goes down. So it actually works as a balancing effect in many respects. The flip side is people like China and Europe get pissed off with it because everybody's a function of the US liquidity. And the dollar is used as therefore an economic weapon that's not in anybody's control, which is why both China, Europe and others have started to try and push back on the dominance of the dollar. The dollar is so incredibly dominant. It's like 80% of world trade is in dollars. And they want it back to a more reasonable level that better represents the size of the US economy in the global picture. So the US economy is what, 25% of the global economy, down from about 40% due to the rise of China and India and others. So the dollar should be 25% of global trade. Now, it's the reserve currency, so maybe 50% would be the right number, but it's too much. And people just don't like that reliance on the dollar because it breaks other people's economies when something's going on in the US. A lot of what Cathie Wood looks at, or a whole bunch of other people. These technologies like AI, electric vehicles, green energy, space, robotics, genetic sciences. You don't put the genie back in the bottle just because you raised interest rates. The technology keeps moving forwards. So what happens is they actually get cheaper over time if they're trading even sideways. So much the same as crypto, you need to put them into a nice logarithmic channel. And things like Amazon have been in a perfect log channel since it launched. And it sometimes gets 2 standard deviations oversold and maybe 3 standard deviations oversold. And that's usually the sign that you've had a capitulation, unless the network is failing.